Hello, friends. If you are 62 or older, or if you are getting close and already thinking about where you want to spend the next chapter of your life, I need you to stop whatever you are doing right now because what I am about to share with you affects your money, your benefits, and your retirement security directly. And most people do not find out about these changes until they have already packed the moving truck, already sold the house, already set down roots in a state that is now working against them financially in ways they never saw coming. Because here is what happened. 12 states across this country quietly changed the rules for retirees. Some of them changed tax laws. Some of them changed benefit eligibility. Some of them changed property tax exemptions that seniors have been counting on for years. And they did not send you a letter. They did not run a commercial. They did not call your financial advisor. The changes went into effect, and millions of retirees found out the hard way through a higher tax bill, a denied exemption, or a benefit that simply disappeared from one year to the next. Today I am walking you through all 12 states, what changed, what it means for your retirement income, and what you can do about it right now. Stay until the end because the last few states on this list have the most dramatic changes, and one of them is going to genuinely surprise you. It surprised me when I looked into it. Before we get into it, subscribe to this channel right now and turn on the notification bell. I cover retirement finances in plain English, Social Security, Medicare, property taxes, pension rules, benefits, all of the things that directly affect how much money you actually keep every single month. The people subscribed here find out about these changes before they get hit by them. Subscribe now. Let's get into it. Now, before I go through the 12 states, I want you to understand something important about how these rule changes actually work, because it changes how you need to think about all of this. When a state changes a retirement-related rule, it almost never affects everyone the same way. These changes are almost always income-tiered, age-tiered, or asset-tiered. That means the same rule change that devastates one retiree's budget has zero effect on another retiree living in the same zip code. So as I go through each state, I am going to tell you who gets hurt the most, who gets protected, and who might actually benefit from the change. Because in a handful of these states, the rule changes actually created new opportunities for retirees who know how to position themselves correctly. The other thing you need to understand is the difference between a tax change and a benefit change. A tax change affects how much of your income goes back to the state. A benefit change affects the programs, exemptions, and services you can access. Both cost you money, but they cost you money in different ways, and they require different responses. Keep that distinction in mind as we go through these states. State number 1, Missouri. Missouri just made one of the biggest moves in favor of retirees of any state in the last 5 years, and almost nobody is talking about it. Starting in 2024 and now fully in effect in 2026, Missouri completely eliminated state income tax on Social Security benefits for all residents, regardless of income level. Before this change, Missouri taxed Social Security benefits on a sliding scale based on income. If you earned more than $85,000 as a single filer, you were paying Missouri state income tax on a portion of your Social Security check every single year. That is now gone, completely eliminated. For a retiree collecting $24,000 a year in Social Security benefits, this change puts hundreds of dollars back in their pocket annually. Money that the state was quietly taking that most people did not even realize they were losing. Missouri also simultaneously lowered its top income tax rate, which now sits at 4.8% and is scheduled to drop further. For retirees with pension income or IRA withdrawals layered on top of their Social Security, this is a meaningful reduction in their overall state tax burden. Missouri does not have the name recognition of Florida or Texas, but the 2026 numbers tell a story that is hard to ignore, especially given its relatively moderate cost of living and reasonable property taxes in most counties. State number 2, Nebraska. Nebraska went the opposite direction from Missouri for years, and it was costing retirees significantly. Nebraska was one of the last holdout states that taxed Social Security benefits at a high rate, which made it genuinely difficult to justify retiring there on a fixed income. But the state legislature passed a phased elimination of the Social Security income tax, and by 2025, that exemption reached 100%. Nebraska now joins the majority of states that do not touch your Social Security check at the state level. What makes this a rule change that caught people off guard is the speed of the phase-out. Retirees who had been planning around Nebraska's old tax structure, running their numbers assuming they would owe state taxes on their benefits, suddenly found themselves with more money than they budgeted for. That is the good kind of surprise. However, Nebraska's property taxes remain among the highest in the Midwest, and the state is actively working on reform there too, though it has not yet reached the same level of resolution. If you are considering Nebraska or already live there, the Social Security tax elimination is a real and meaningful improvement, but you need to run your full picture numbers, including what you are paying on your home. State number 3, West Virginia. West Virginia completed its own Social Security tax phase-out, and it matters enormously for the retirees who live there. West Virginia had taxed Social Security benefits for higher income earners for years, and for a state where a large percentage of the population is retired and living on modest fixed incomes, that was a genuine financial burden. The elimination of that tax, now complete, represents hundreds to over $1,000 per year back into retirees' pockets, depending on their income level. West Virginia is also one of the more affordable states in the country from a pure cost of living standpoint. Housing is relatively inexpensive, and the state has been actively working to make itself more competitive as a retirement destination. The downsides are real and should not be glossed over. Healthcare access in rural West Virginia can be a serious challenge. Specialist availability is limited compared to more urban states, and the infrastructure in some areas is not what retirees who move from major metropolitan areas might expect. But for retirees primarily focused on keeping their fixed income intact and living affordably, West Virginia's recent tax changes move it into a more competitive position than it has held in recent memory. State number 4, Colorado. Colorado changed its rules in a way that benefits some retirees and creates confusion for others. And the confusion part is important to understand. Colorado has long had a pension and retirement income deduction for seniors, but the thresholds and structures have been adjusted. For retirees 65 and older, Colorado now allows a larger deduction on retirement income, which reduces the amount of taxable income you report to the state. However, Colorado still taxes Social Security benefits for higher income earners, and the state income tax, while a flat 4.4%, does apply to income above the exemption thresholds. The rule change that caught people off guard in Colorado was on the property tax side. Colorado passed significant property tax relief targeted at longtime homeowners and seniors, with senior-specific property tax exemption programs that reduce the assessed value of a primary residence for qualifying seniors. But the eligibility requirements changed, and some seniors who had been receiving the exemption found they needed to reapply or re-verify their eligibility under the new structure. If you are in Colorado and you were previously receiving a senior property tax exemption, verify with your county assessor that you are still properly enrolled under the updated rules. That is an easy thing to let slip and an expensive mistake if it does. State number 5, New Mexico. New Mexico made a dramatic shift that genuinely changed the retirement calculus for the state. For years, New Mexico was a state retirees avoided specifically because it was one of the few states in the country that taxed all retirement income, including Social Security, at the state level. It was a real and persistent knock against the state. Then the legislature eliminated Social Security taxation for residents below a certain income threshold, and the threshold is quite reasonable. For single filers earning under $100,000 adjusted gross income and married couples under $150,000, Social Security benefits are now completely exempt from New Mexico state income tax. Given that the vast majority of retirees fall well below those thresholds, this change effectively exempts most of New Mexico's retirees from Social Security taxation entirely. New Mexico also has one of the lowest overall costs of living in the Southwest, and is a genuinely beautiful state with significant cultural appeal. The change has not yet triggered a flood of retirement migration to New Mexico because it is not yet well known, which means the state is currently underpriced as a retirement destination relative to where it probably belongs in the rankings. State number 6, Kansas. Kansas eliminated its state income tax on Social Security benefits, and the change took effect in a way that surprised a lot of long-term residents. Kansas had taxed Social Security for decades, and the elimination was something retirees in the state had been pushing for through their legislators for years. The practical effect is that a Kansas retiree collecting the average Social Security benefit now keeps more of that money at the state level than they ever have before. Kansas is not a state that generates retirement destination headlines. It does not have Florida's weather or Arizona's scenery, but the combination of eliminated Social Security taxation, relatively moderate income taxes on other retirement income, and genuinely affordable housing in most of the state creates a full picture that is more competitive than the state gets credit for in mainstream retirement planning conversations. The property taxes in Kansas are moderate, not the lowest in the country, but far from the highest, and the cost of living overall allows retirement savings to stretch considerably further than they would in coastal or high-demand states. State number 7, Illinois. Illinois shows up on this list for a reason that will surprise most people, because Illinois has one of the worst financial reputations of any state in the country. The state pension crisis is real, the debt load is real, the political dysfunction is real, and yet, For retirees, Illinois has one of the most favorable income tax structures anywhere in the United States. Illinois has a flat 4.95% income tax rate, and it fully exempts all retirement income. Social Security is not taxed. Pension income is not taxed. IRA withdrawals are not taxed. 401k distributions are not taxed. The tax applies to working income, not retirement income. The rule change that matters here is the ongoing and periodically threatened legislative discussion about whether to modify the retirement income exemption. The exemption has been protected by the Illinois Constitution, but there have been legislative discussions about restructuring it. So far, it has held. But retirees in Illinois, and those considering moving there, need to watch this space. Because if Illinois ever succeeds in modifying its retirement income tax treatment, it would significantly change the financial picture. For now, the exemption stands, and it makes Illinois legitimately one of the best states for retirement income preservation, despite everything else the state has going against it. State number 8, North Dakota. North Dakota has quietly made itself more competitive for retirees, and the changes are recent enough that most retirement planning guides have not caught up to the new reality. North Dakota eliminated its state income tax on Social Security benefits and simultaneously restructured its income tax rates downward. The state has also been running budget surpluses driven by energy revenues, which has put it in an unusual financial position compared to most states and created room for tax relief that many other states simply cannot afford. North Dakota is not a state that appears on most retirees' radar for lifestyle reasons. The winters are severe, the population is sparse, and the entertainment and cultural amenities are limited compared to larger metro-adjacent states. But for a retiree who is not interested in paying the lifestyle premium that comes with living somewhere like Arizona or the Carolinas, and who wants to maximize the amount of their fixed income they actually keep, North Dakota's updated tax structure is genuinely worth looking at. The cost of living is low, the property taxes are reasonable, and the recent income tax reductions have made the overall financial environment more favorable than it has been in decades. State number 9, Connecticut. Connecticut appears on this list because it changed its rules in a way that matters enormously to moderate income retirees, but that almost nobody explained properly when the change happened. Connecticut had one of the most aggressive retirement income tax structures in the Northeast, taxing Social Security, pensions, IRA withdrawals, and annuity income for retirees above certain income thresholds. The change created significant new exemptions specifically for moderate income retirees. If you are married and your adjusted gross income is under $100,000 or single under $75,000, a very large portion of your retirement income is now exempt from Connecticut state income tax. Below those thresholds, Connecticut is a materially different state financially than it was 5 years ago. Above those thresholds, it remains expensive and tax-heavy. The critical mistake people make with Connecticut is they hear the state's name, they associate it with high taxes and high cost of living, and they dismiss it without running the actual numbers for their specific income level. For a moderate income retiree, the updated exemption structure changes the picture substantially. For a high-income retiree with significant taxable income above the thresholds, Connecticut remains one of the more expensive states in the Northeast. State number 10, Vermont. Vermont changed its Social Security taxation rules, and the change moved it in a better direction for retirees, though Vermont remains an expensive state overall. Vermont previously taxed Social Security benefits based on federal taxable Social Security income, which meant retirees above certain income levels were paying state tax on their benefits. The updated rules increased the income thresholds for exemption and reduced the effective tax burden for many retirees in the middle income range. Vermont is never going to compete with Florida or Texas on tax friendliness, and it is not trying to. The appeal of Vermont as a retirement destination is different. It is the quality of life, the healthcare system, the natural environment, and the tight community infrastructure. But the Social Security tax change is real, and it represents money back in the pockets of retirees who are already there. If you are in Vermont, or considering it, and your income falls below the updated thresholds, verify your new tax liability, because you may be paying taxes you no longer owe. State number 11, Montana. Montana is on this list because it changed its rules in a way that hurt some retirees who were not paying attention, and the change happened fast enough that it caught people off guard. Montana taxes Social Security benefits for higher income retirees, and while the basic structure has been in place for years, the state adjusted the income thresholds without a proportional adjustment for inflation, which means the effective number of retirees subject to the tax quietly expanded, even though the published rules look the same. A retiree who was below the threshold 5 years ago may now be above it simply because their cost of living adjustments on Social Security pushed their gross income over the line. Montana is a beautiful state with genuine appeal as a retirement destination, and the overall tax burden is moderate. But the Social Security threshold adjustment is the kind of quiet rule change that does not generate headlines and cost retirees money without them realizing exactly what changed or when. State number 12, Minnesota. Minnesota rounds out this list, and it deserves its spot because it underwent a rule change that was simultaneously the most well-publicized and the most misunderstood. Minnesota partially exempted Social Security benefits from state income tax for the first time in recent history, targeting relief at lower and moderate income retirees. For single filers below $78,000 and married filers below $100,000, a meaningful portion of Social Security benefits is now exempt from Minnesota state income tax. That is a real change that real retirees are feeling in their annual tax bills. But here is what gets lost in the coverage of this change. Minnesota still taxes IRA withdrawals, 401k distributions, and pension income at rates between 5.35% and 9.85%. The Social Security exemption is meaningful, but it does not change the fact that Minnesota remains one of the more tax-heavy states in the country for retirees with significant income from retirement accounts. The health care in Minnesota is genuinely excellent, some of the best in the country by most quality metrics. And for retirees in later years when medical needs increase, that has real financial value. But retirees primarily focused on income preservation should run the full numbers on all income sources, not just their Social Security, before concluding that the partial exemption changes Minnesota's fundamental financial profile. Now, here is the honest framework you need to use when you look at any of these 12 states, because the individual rules only tell you part of the story. The right way to evaluate a retirement state is not to find the one most favorable rule and build your decision around it. It is to look at the total cost of living in that state across every category simultaneously. Income taxes on every source of your income, property taxes on the kind of home you realistically plan to own or rent, sales taxes on your everyday spending, including groceries, homeowners insurance and how it is trending in that state, healthcare access and the quality of the Medicare Advantage plans available in your county, and finally, the overall cost of daily life, utilities, transportation, food, and services. When you run that complete calculation for your specific income sources, your specific housing situation, and your specific health needs, the answer almost always looks different from what any single headline or ranking would suggest. A state that looks terrible based on its income tax rate might be excellent for you once you account for a property tax exemption you qualify for. A state that looks perfect based on no income tax might be devastating once you price in homeowners insurance or property tax rates that have been quietly climbing. The tools to do this calculation exist, and they are free. SmartAsset has a retirement tax calculator that allows you to enter your specific income sources and compare your after-tax income across states. It takes about 15 minutes to use properly. Run it. The number that comes out will tell you more than any ranking list can. Subscribe to this channel right now, share this video with someone who is planning their retirement or who already lives in one of these states, because this is exactly the kind of information that does not reach people until it is too late to act on it. The bell notification is on. I am publishing this information on a regular basis, and you want to be here when the next round of changes comes through, because based on everything happening in state legislatures right now, there are more changes coming, and the people who know about them in advance are the ones who can plan around them instead of getting blindsided by them.